Welcome students to today's lecture on intriguing relationship between lower interest rates and investment spending. Interest rates are the cost of borrowing money. They are set by central banks such as the Federal Reserve in the United States and the central bank in other states. Investment spending is the money that businesses spend on physical assets or projects that will generate future income. When interest rates are low, it is cheaper for business to borrow money to invest. This makes business more likely to undertake new projects and expand their operation. This increased investment spending can stimulate economic growth. There are two main reasons why lower interest rates lead to higher investment spending. Lower cost of capital. When interest rates are low, it reduces the cost of capital for business. This means the hurdle rate for potential investment is lower, making a wider range of projects financially viable. Lower interest rate can also stimulate consumer spending. When consumers have access to cheaper credits, they may be more inclined to make significant purchases such as homes and automobiles. This in turn can boost industry related to consumer goods. While lower interest rate can stimulate economic activity, they can also lead to concern about inflation. If the economy overheats due to excessive borrowing and spending, it can result in rising prices, potentially eroding the purchasing power of consumers. Banks have limited room to maneuver and stimulate further economic activity through traditional interest rate reduction. Finally, the effectiveness of lower interest rates in stimulating investment spending can vary depending on the timing and overall economic decision or condition. During a severe economic downturn, lower rates may not be sufficient to encourage investment if businesses are uncertain about the future. The relationship between lower interest rate and investment spending is a complex but crucial one. Lower rates can indeed incentivize business to invest, stimulate consumer spending, and promote economic growth. However, we must also be mindful of the potential risks such as inflation and the limitation of monetary policy. As future economists, it is essential to keep a watchful eye on interest rate movement and the impact on investment spending, as these dynamics play a pivotal role in shaping the economic landscape. In addition to the point mentioned above, it is important to know that the impact of lower interest rates on investment spending can also be affected by several other factors, including government policy, such as tax break and subsidy. Business needs to have access to credit to invest. If banks are reluctant to lend money to business, this can deepen investment spending. Business confidence is another important factor that influences investment decision. If businesses are optimistic about the future, they are more likely to invest. Policymakers need to consider all these factors when designing policies to stimulate investment spending. Thank you for watching this important video. See you in the next class.